Today, I'd like to delve into the intriguing developments surrounding short sellers, who aren't just losing billions, but are now plunging into the abyss of hundreds of billions in losses. This has rippling consequences, notably impacting the largest pension fund in the United States, thrusting it into a precarious situation. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell, so you never miss any of our uploads, and also enter our giveaway. But everyone remember, this is not a financial advice video. Let's first dissect the financial turmoil experienced by short sellers, with a focus on B. Riley. Crystal Ball took to Twitter to highlight the perplexing scenario where B. Riley managed to post a net loss exceeding $75 million, despite boasting record revenues. The discrepancy raised questions about the root cause, whether it's escalating costs or colossal realized losses. It appears that the substantial unrealized investment losses, particularly related to mark-to-market valuations on equity portfolios, are driving this financial predicament for B. Riley. Their financial report for Q3 exhibited a staggering $462 million in total revenues, a remarkable 48% increase year over year, juxtaposed against a net loss of $75.8 million. This dissonance, characterized by substantial unrealized losses on stock investments or short positions, underscores the challenges faced by short sellers and hedge funds. The repercussions of these staggering losses extend beyond individual financial entities. The impact reverberates through the financial system, affecting even the largest pension fund in the United States. A tweet from Gold Telegraph reveals that the United States' second-largest pension fund is contemplating borrowing more than $30 billion in cash to bolster its liquidity without resorting to selling assets at distressed prices. This signals a dire situation where the pension fund is struggling to meet margin requirements, prompting the decision to opt for borrowing a substantial amount instead of liquidating assets. The magnitude of this borrowing, at $30 billion, underscores the severity of the fund failure to meet margin requirements. To corroborate this, a Bloomberg article reports that CalSTR's California State Teachers Retirement System, the country's second-largest pension fund, seeks to borrow more than $30 billion to manage cash. This move involves borrowing against 10% of its entire portfolio, reflecting a broader trend of pension funds adopting riskier investment strategies. The domino effect of hedge funds incurring significant losses directly impacts retirement systems like CalSTR's, compelling them to borrow additional funds to safeguard their portfolios from liquidation. The gravity of this situation becomes more apparent when considering the underlying investments. Hedge funds responsible for managing pension fund assets are witnessing substantial losses, necessitating these borrowing maneuvers. The ripple effect reaches innocent retirees whose financial futures are entwined with these pension funds. A lack of autonomy in choosing where their money is invested makes the situation all the more disconcerting for individual teachers relying on these funds. Moving beyond individual firms and pension funds, the broader financial landscape is facing challenges from short sellers' unrealized losses. Suzanne Trimbath's tweet reveals alarming statistics from the Depository Trust and Clearing Corporation (DTCC), indicating a meager 3% cash collateral or margin supporting $0.3 trillion in guaranteed open positions. The poorly capitalized nature of the DTCC raises concerns about systemic risks, as a single downfall within the organization could have widespread repercussions. Counterfeit shares flooding the financial system add another layer of complexity, with regulators struggling to grasp the extent of the fraud. The tweet from Kristen Shaughnessy highlights the challenges regulators face, emphasizing the lack of transparency and the potential magnitude of the fraud. Suzanne Trimbath's statement on Twitter further amplifies the risk, pointing out that $12 billion is protecting $250 billion in IS. The discrepancy between the cash support and the potential losses in the event of a market upswing raises concerns about the fragility of the system. Regulators, prime brokers, market makers, and others involved in the financial ecosystem appear to be engaged in a blame-shifting exercise, avoiding responsibility for the synthetic shares conundrum. This lack of accountability has contributed to the prolonged inaction on addressing synthetic shorting. In a related development, a tweet from 741 Trey highlights the First Bank, UBS, facing fines in 2024. The ongoing challenges stemming from UBS' takeover of Credit Suisse indicate potential vulnerabilities in the financial sector. The accumulation of fines and problems suggests that UBS might be on the brink of collapse, adding another layer of instability to the financial landscape. On a more optimistic note, an upcoming iconic music event slated for AMC theaters on March 21, 2024 promises additional revenue streams. The untitled event hints at yet another lucrative concert that could contribute significantly to AMC profits. Adam Aaron confirmation that Taylor Swift has generated a staggering $261 million globally at the box office further boosts the outlook for AMC. With AMC holding rights to over 40% of the income and additional revenue from concession sales during theater showings, the company is positioned for increased profitability. As more revenues pour in, the potential for a surge in the AMC stock price becomes evident, setting the stage for a new all-time high. In conclusion, the intricate interplay between short sellers' losses, pension fund challenges, regulatory dilemmas, and financial institutions' struggles underscores the complexity of the current financial landscape. The consequences of these developments extend beyond individual entities, impacting the broader market dynamics. As the financial ecosystem grapples with uncertainties and risk factors, stakeholders must navigate carefully to mitigate potential systemic disruptions. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.